Hello students, myself is Parminder Singh from Prab Kirpa classes. Our today's topic is understanding and addressing balance of payments imbalances. We have already learned that balance of payments is a systematic record of all economic transactions which take place between the residents of one country and the rest of the world during a specified period. What it means? It means that a country may be exporting certain goods and services to the outside world, and it may be also importing certain goods and services from the rest of the world. A country may be giving some loan to other countries, or it may be receiving loans from the other countries. It may be making investments abroad, or it may be receiving investments from abroad. Sometimes it may be giving aid on humanitarian ground to other countries, that is the rest of the countries, rest of the world, or it may be receiving some aid or donations or gifts from the rest of the world. So balance of payment is a record of all these economic transactions. So all these economic transactions either result into inflow of foreign exchange or outflow of foreign exchange. Either foreign exchange is coming into the country as a result of these activities, or foreign exchange is going outside the country. So three situations arise due to these activities, and what are those? Outflow may be equal to inflow, outflow may be more than inflow, or outflow may be less than inflow. That is either foreign exchange which we are getting may be more or less or equal to inflow or outflow, as the case may be. Now we will also understand what are the reasons which contribute to the imbalance in the balance of payments position. Why inflow of foreign exchange is not equal to the outflow of foreign exchange? The possible reasons may be exports may be less than the imports, or there may be natural causes such as droughts or floods, or the other reasons may be capital flight or demonstration effect, population is increasing. These are some of the factors. We will discuss all these in detail. Then we will also discuss what steps can be taken to improve the balance of payments position. We can take certain steps to increase exports, to decrease imports. We can take steps to improve, to attract the foreign investors. We can also take steps to reduce the bureaucratic hurdles. We will discuss all in detail in this course. Then we will also discuss that autonomous transactions are also known as above the line transactions, and these transactions are undertaken with a profit motive in mind. And if any imbalance arises due to the autonomous transactions, then to balance out the imbalance in the balance of payments, accommodating transactions, which are also known as below the line transactions, these are undertaken, and these transactions are undertaken by the government. We will discuss all these in detail and hope you will find this course very useful. Now the topic before us is exploring equilibrium, positive and negative in balance of payments. In the case of balance of payments, as per accounting sense, balance of payments is always balanced. But in the economic sense, balance of payments may be balanced, or sometimes it may be surplus or even deficit. The reasons for the same may be economic reasons or policies of the government and some other reasons. Before proceeding further, we should have an overview of how balance of payment looks like. Balance of payment looks like a accounting statement in which there are two sides. One is debit side and the other is credit side. Credit side is shown as positive and debit is negative because In the case of debit side, we record all outflows of foreign exchange. Here we record all inflows of foreign exchange. That is, in the case of debit, we take all those economic transactions due to which there is outflow of foreign exchange. And on the credit side, we take all those economic transactions which result into inflow of foreign exchange. For example, if we export goods or export services, what it means? It means that foreign exchange comes into our country. So, export of goods and export of services are taken on the credit side because they result into inflow of foreign exchange. On the other hand, if we import goods and services, what happens? If we import goods, then we will have to pay foreign exchange. So these are recorded on the debit side of the balance of payments. Here we write import of goods, import of services. We may also add that when we are talking about goods, these are also known as visibles because goods can be seen and touched. On the other hand, services are also known as invisible items because the services such as banking, insurance, shipping cannot be seen or touched. So there are some other items also, such as in case of need, such as on humanitarian ground, we may get foreign aid, or we may also receive some gifts, or we may receive donations from the rest of the world. So when we receive unilateral transfers, it means inflow of foreign exchange. Unilateral transfers received. On the other hand, if we give donations, aid to the rest of the world on humanitarian ground or due to some other reason, these result into outflow of foreign exchange. So unilateral transfers paid to the rest of the world. So in the same way, when we make investments abroad, then we may receive dividend, profits, or rent from investments abroad. So these are the income received in the shape of rent, interest, dividend from abroad. In the same way, if foreign people have invested in our country, they may receive income in the form of interest, profit, dividend, and rent, income paid abroad, paid to abroad. And in the same way, sometimes we receive or borrow money from abroad. When we borrow from abroad, what it happens? Then foreign exchange comes into our country. And when we lend to abroad, foreign exchange goes out of our country, lending abroad. Then sometimes we make investments abroad. If we make investments, then what happens? Foreign exchange goes outside our country. investments abroad. And if we receive investments from abroad, then foreign exchange comes into our country. So this is the a broad overview. There are maybe some more items which might be appearing in the balance of payments. We are shortly writing it as BOP, but when you are to write somewhere, you are to make full form balance of payments. This is a short or brief overview of the balance of payments. Many more items will be appearing in the balance of payments statement or balance of payment record. So when we are talking about balanced BOP, what it means? Now we have having a bird's eye view of BOP, what it actually looks like. So balanced BOP is a stage or a situation when credit is equal to debit. It means that all total of total inflow of foreign exchange of the whole country is equal to the outflow of foreign exchange, total outflow of foreign exchange. Inflow is equal to outflow. Total inflow of foreign exchange is equal to total outflow of foreign exchange. In the case of surplus BOP, surplus means we are having credit is more than debit. So when credit is more than debit, it means that here we have written inflow of foreign exchange. Total inflow of foreign exchange in the country is more than total outflow of foreign exchange. That is, the foreign exchange which is coming into our country is more than the foreign exchange which is going out of our country. Inflow is more than outflow. When we are talking about deficit BOP, it means that credit is less than debit. So all the entries which will be appearing on the debit side of the BOP will be more. In other words, credit will be less than debit. So here inflow of foreign exchange is less than total outflow of foreign exchange in the country. So these are three different situations in respect of balance of payments. And if there is some disequilibrium in BOP, the government takes necessary steps so that there is equilibrium in balance of payments. We hope you might have understood this concept in very clear terms. Now the topic before us is from red to black, redefining the color of your balance of payments with actionable strategies. In other words, it means how can a country improve its balance of payments position over the long term. First of all, the question arises, what is balance of payments? Balance of payments is a systematic record of all the economic transactions which take place between the residents of a country and the rest of the world during a specified period. A country may export certain goods and services to rest of the world and may also import other goods and services for its use. A country may send one-time transfer, such as it may give aid, donations or gift to other countries, or it may receive also at other times. sometimes a country gives loans to other countries. At other times, the residents of a country may avail the loan from the abroad. Sometimes investors from our country make investments abroad, and sometimes foreign investors make investment in our country. So these are all economic transactions in which either foreign exchange goes out of the country or foreign exchange comes into our country. So balance of payment is a record which takes note of all these economic transactions. As already told, that balance of payments is just like this, where on one side we have debit entries and on the other side we have credit entries. All the outflows of foreign exchange, all the transactions which result into outflows of forex, foreign exchange, are recorded on the left hand side, and all the activities on account of which inflows of foreign exchange occurs are recorded on the credit side. When we are talking about the balance of payments position, how to improve the same, it means that either outflow is more than inflows, that is, we are receiving less foreign exchange and more foreign exchange is going outside. Improving balance of payment does not necessarily means that the balance of payments position has to be balanced, that is, credit should be equal to debit or credit should be more than debit, that is, balance of payments position should be either balanced or it should be surplus. This is the balanced balance of payment. This is when credit is more than debit, that is, inflow is more than outflow, it means that there is surplus balance of payment. When we are talking about the improving balance of payment, it does not necessarily means that balance of position payment has to be either balanced or surplus. Rather, improving balance of payment means that if there is any imbalance, it has to be within a certain range, within a manageable range. It should not be excessive. If there is any deficit in the balance of payments, then it should not be excess. That is, it is not that key outflows are exceed quite in large numbers than the inflows. For example, we may say that, say in the previous year, our country received 1000 crore rupees as inflows, as inflows. On the other hand, the outflow was only 90 crores. It may be also quite possible that in the previous year, inflow was 1000 crore and outflow was, say, 90 crore. That is, overall, either the balance of payment was either stable, neutral, balanced, or we were receiving more inflow of foreign exchange. But when we are talking about the improving the balance of payment position, it means that it should not happen that in the previous year there was normal or may not have been normal, but it does not mean that it should be abnormal balance of payment position. That is, it should not happen that our outflows are, we are taking just example, or our outflows are 2000 crore and our inflows are only 90 crores. That is, there should not be abnormal difference in debit and credit side. That is, it is not that there should be huge gap in inflow and outflow. Improving balance of payment means we have to take steps to keep the difference between inflow and outflow to the manageable level. There should not be abnormal increase, or outflow should be at a quite higher level. How? What steps which can be taken by our country to improve the balance of payment position? What steps we can take, our country can take? First is enhancing exports. These are some of the steps which can be taken: enhancing exports, reducing imports, attracting foreign direct investment, managing debt and financial flows, the long-term structural reforms. Now we will discuss each of these one by one. First is enhancing exports. To enhance exports, what steps can be taken? First is that we can reduce export duty. Export duty to be reduced. Or we can give incentives to exporters. It may be in the form of cash or in the form of certain other methods. Or not only reducing cash export duty, we can also give rebates in income tax to exporters, or we can also give some sort of rebates in some local taxes which we impose normally. And in the case of exporters, we may give certain rebates in case of domestic taxes. We should also make investment in research and development and technology, so that we are in a position to produce quality goods and services, and they have good recognition in the export market, and so that our exports increase. To enhance exports, we can also find some more countries where we can send our goods and services. That is where we can export our goods and services. And we can also find out those goods and services which we can export. In addition to the goods and services which we are exporting, we have to find out more goods and services which we can export or which have demand in the foreign countries. Next is to improve the balance of payment position, that is to attract more foreign investment, to have foreign exchange, to get more foreign exchange from the rest of the world. We should reduce imports. How it is possible? To reduce imports, we can increase the import duties. Then what we can do? We can find out import substitution. That is, we are to find out the substitution items for the goods which we are importing, and then we have to raise awareness about these import substituted goods, that so that the residents of the country should use these substitution products in place of imported goods. Next, we can fix the limit of imports of goods and services during a particular period. This is the maximum limit which can be imported. Next is attracting foreign direct investment. We should take steps to attract foreign direct investment. We can offer attractive tax incentives to attract foreign investors so that they make investment in our country. If our tax incentives are attractive, then the foreign investors will bring in the foreign investment in our country. That is, the foreign exchange will flow into our country. Then government of the country should implement sound fiscal and monetary policies. What are those? Prudent management of government spending and taxes. That is, it should have a proper management of the government spending. That is, it should look where it should spend money and what type of taxes should be imposed, or what are those taxes which should be reduced, so that there is favorable atmosphere in the whole of the economy. Then the government of the country can implement suitable monetary policies with regard to money supply and interest rates. These steps of money supply related issues are taken by the central bank or monetary authority of the country. Then the government can also take steps to ensure that there is proper supervision of financial system so that any financial crisis may not arise. Further, we should take steps, or we should encourage domestic savings so that our reliance on foreign investment is reduced. Next is long-term structural reforms. It sometimes happens that if in a country there are lot of bureaucratic hurdles, the investors do not come forward to make investment in those countries. So bureaucratic hurdles should be reduced. Ease of doing business should be there. Steps should be taken by the country to address those political and social issues which discourage the investment in the country. Further, we should make investment in education and infrastructure so that a skilled labor or skilled manpower is there, so that we can take advantage of the same. Then we should take steps that normally it happens that in any country big industries or big houses are in a position to avail loan very easily. Small businesses or the MSME sector, that is the medium level people or middle level businessmen or middle level manufacturers, are not in a position, small scale industries are not in a position to get or avail loan from the financial institutions easily. So the government of the country should take steps that MSME sector easily gets the facility of finance so that they can produce goods and services. And when they produce goods and services, then it will automatically improve our exports, increase in exports and reduction in exports. So in this way, by taking all these steps, we can improve our balance of payments position. That is, we will not have to rely on foreign exchange more. When the import of the country is less, we take steps to improve our exports and take steps to reduce imports and taking other steps such as physical and monetary steps, then we can surely improve our balance of payments position. Improving the balance of payments position is a complex and ongoing process. It is not that we have taken steps and we take rest. No, it is a continuous process, ongoing process that requires combination of sound economic policies, structural reforms, and long-term vision. And on account of these only we can achieve sustainable economic growth and development. Thanks for watching. If you like our course, please spare some time to give a star rating to our course.